Yeah, good day, everyone. Today is Saturday, the 3rd of September, 2022. Today we'll be having our part 4 discussion on the consolidated statement of profit or loss and other comprehensive income. And today we'll begin by looking at the principle that borders on how do we unwind discounts and how do you recognize such unwound discount or contingent or deferred consideration as a finance cost in the books of the group. Okay, and if you can remember what is a deferred consideration or what is a contingent consideration. A deferred consideration is considered a consideration where in a business combination, you probably agree to buy and the other party agrees to sell a stake in the company for, let's say, 100 million naira, and of which your agreement is such that you pay 80 million naira today, and you pay the balance of 20 million naira in a year or 2 years' time. And in that case, we need to recognize the 20 million that is payable at a future date in a year or 2 years' time or beyond as a deferred consideration. And such consideration is to be recognized at its present value, provided it's a monetary amount, which means something that is payable in cash. Okay, whereas if it's going to be payable in shares or payable in other assets other than cash, in that situation, it will be recognized at the fair value, which is probably the market value of whatever the asset is or the shares is. Okay, now the question then is, we are looking at the monetary value in this context, a deferred cash consideration, where you need to unwind discounts, inherit is the present value on a year-on-year basis up to the point of settlement. How do we carry out this unwinding, which we have also done at the point of consolidation or statement of financial position of the parent and the subsidiary? We are also going to repeat similar thing here, but instead of us aggregating it in terms of cumulative effect, we'll only be considering the effects in profit or loss for the current period. Okay, while the cumulative effect before the current period will be affected in the opening consolidated retained earnings. Now we're going to look at that in the course of this discussion, which we will look at one or two illustrations on this deferred consideration. One in which this is the first year we are recognizing the finance cost, which is in one discount. And the second scenario probably is where we are looking at a situation where we are unwinding in the second year, which means what will have been the cumulative effect as our first year, which will impact the opening consolidated retained earnings for the group, while the current period will impact true profit or loss for the group. Okay, thereafter, we are also going to look at other aspects, such as, I think we'll be looking at aspects that borders on, let me check. We'll be looking at aspects that borders on treatment of preferred dividend, yeah? And we're going to look at 3 scenarios in that situation, where the entire preferred dividend or preferred shares is held by the parent. 2, when the entire preference share is held by other shareholders, which is a non-controlling interest. Okay, and thirdly, where the preference share is partly held by the parent and partly held by others. And in this case, we are looking at preference shares strictly from the perspective of equity. Okay, remember we've discussed the aspect of loan, and preference share that is treated as a loan or as a financial liability in line with IAS 32 will similarly be treated in the same manner we have treated loan. And we're going to eliminate intercompany loan and also intercompany preference share in that light. Which then means that any component of preference share held by others other than the parent, where such preference share is treated as a financial liability, will be considered as a liability, which is a component of non-current liability, rather than as equity, which would have been a component of non-controlling interest. But wherever the preference share capital is treated as equity, in line with IAS 32, it then presupposes that any component of it that is attributed to others other than the parent will be strictly considered as a component of non-controlling interest. Okay, that is that. Thereafter, we'll wrap it up and we can start a new section where we'll be discussing on investment in associates and joint venture. And thereafter, before we delve into the joint venture aspect, we'll take time to look at IFRS 11 that speaks extensively on what we can perceive as a joint arrangement, where we'll be looking at the possible two arrangements that can occur. One is a jointly controlled entity, the other one is a jointly controlled operations. And we're going to look at all of these things as time moves on. Okay, in that light, I think we'll start. I believe you can hear me. Can you hear me, since?
Yes.
Shamas. Yeah,
yes, sir.
You guys can hear me, since. Okay. Thank you very much. Now, let me share where we'll start from today. We'll start from the angle of deferred consideration. Now, can somebody read illustration 21?
Okay, 11th principle, unwinding of discounts on deferred or contingent consideration. Illustration 21. Arsenal 80% interest in the equity of Chelsea as January 1st, 2016. The board of Arsenal strictly wants to comply with the requirement of Arsenal regarding consolidation of the financial statements of the subsidiary with that of the parent as December 31st, 2016. Income statement for the year ended December 31st, 2016 for Arsenal and Chelsea. All figures in thousands of naira. Revenue 600,000 naira for Arsenal and 390 for Chelsea. Cost of sales 345,000 for Arsenal, 201,000 naira for Chelsea. Gross profit sums to be 255,000 for Arsenal, 189,000 for Chelsea. Distribution costs for Arsenal 75,000 naira, for Chelsea 45,000 naira. Administrative expenses for Arsenal is 105,000 naira, for Chelsea is 90,000 naira. Profit earned before tax 75,000 naira for Arsenal and 54,000 naira for Chelsea. Income tax 25,000 naira for Arsenal, 29,000 naira for Chelsea. Profit for the year sums up 50,000 naira for Arsenal and 25,000 naira for Chelsea. Okay. Movements in reserves. Retained profit brought forward for Arsenal 120,000, for Chelsea 20,000 naira. Profit for the year sums up 50,000 naira for Arsenal and 25,000 naira for Chelsea. Retained profit carried forward 170,000 naira for Arsenal, 45,000 naira for Chelsea. Required, prepare the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As an acquisition, the parent, in addition to the share consideration, that is share exchange, offered to former shareholders of the subsidiary a cash payment of 28.8 million naira is due to be paid on 31st December 2017 to the shareholders who sold their stakes to the parent. The hurdle rate or cost of capital of Arsenal is 20%.
Okay, thank you very much. Now let's come back to our spreadsheets. The same information has been presented in the spreadsheets, which means we need to draw down the following information. Okay. The first thing I'll look at is when was the date of acquisition? The date of acquisition was 1st of January 2016. And we are consolidating today, which is 31st of December 2016. How many years apart? Just 1 year. Okay, now let's look at the consideration. The purchase consideration is made up of 1, there is a cash consideration. Okay, and in addition to the cash consideration, there is a deferred cash consideration. Now, this deferred cash consideration is how much? 28.8 million. Now, but the issue is that this amount is payable. On 31st of December 2017, which is 2 years' time from acquisition. Therefore, it means at the point of acquisition, we need to find the present value of this amount. Therefore, you need to find the present value of 28,800,000 over a 2-year period. Therefore, what can we do? Recall, what is the formula for present value? PV is future value over 1 plus the cost of capital raised to power n, which is equivalent of future value times 1 plus r raised to power minus n. Now recall, this is the future value, which in this case is 28.8 million. R is the cost of capital or order rate or rate of return, which in this case is set to be what percentage? 20%. And N is period up to settlement, which in this case is 2 years from acquisition. Therefore, what do we do in this slide? We come here to compute the present value. Sorry, okay, I was writing on another page. Where was I writing? Let me copy it. Okay, for what I've done, I've copied it here. Now, I can come here and say my future value is 28.8 million. Remember, all figures in thousands. 28.8 million. Now, what is my discount rate? My discount rate is 20%, as we have it here. And my N is 2 years. Therefore, this is the same formula I've converted here. As you can see, yeah, that is 28 multiplied by 1 plus R raised to power minus 2. Can you see the minus 2 here? Let me enlarge it for you. You can see it here. Now, upon doing that, I've more or less carried out this operation, okay? Now, in today's money, this is 20 million. which is 20 million is the present value of the 28.8 million payable in 2 years' time from point of acquisition. Now, this 20 million plus whatever the cash consideration is will have been the purchase consideration by the parent in the subsidiary. Now, what is our concern? Our concern is that we are in the first year. The first year is 2026, between January 1st and 31st December 2026. It's a full 12-month period of which we are going to unwind discount. How do we unwind the discount? I can write it here. Unwinding the discount in year one is simply to say my finance cost, which is the unwound discount, or the unwound discount in year one is simply the cost of capital multiplied by the present value in year zero. Now, what is cost of capital? 20%. The present value in year zero, if you remember, this is PV in year zero, okay, which is 20 million. And that is how we obtain the 4 million, which is what you have here. This 4 million is what we have here, which is 20% of the 20 million. Okay. I remember all figures are in thousands. This is 4 million. And that is that. Now, how do we treat it? You are going to treat 4 million as if all figures are in thousands here. You treat this 4 million as a debit to your profit or loss, which invariably will reduce your retained earnings, because once your profit or loss reduces, your retained earnings reduces, and this is going to increase your liability, which is a deferred cash consideration. If you could go back to what we discussed in the balance sheet, which means the accounting entry here is for the finance costs. Okay. Okay, therefore, the 4 million increases our profit, reduces our profit by increasing our expense. The finance cost will increase, which is an expense, and it reduces profit. And any reduction in profit automatically will reduce the retained earnings. And likewise, the corresponding entry is that our liability will increase because we are not yet paying, we are only accruing for the implied interest that is in the discount. And that is that, which means at the end of year one, the deferred consideration will have increased from 20 to 24, which means 20 plus 4 will now make it 24. And that is that position there. And that is what we have tried to do here, that you can see in this place, which means before there's no finance cost here, but you see that in our schedule, we now have finance cost, which shows that whatever our finance cost is here, although there's nothing, it shows that we now recognize finance costs from the group perspective, all because of the discount that has been unwound and inherent in the deferred consideration. Therefore, let's go and copy all of the information that are in our profit or loss. Okay? What are the information in our profit or loss? Okay, I can copy this information And therefore, there are no other adjustments. So doing, what has happened? What has simply happened in this case okay, what has simply happened in this case is we've consolidated line by line, 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 subject to the adjustment here. Okay, supposing we have finance costs before, by the time we add it together, we add this to it to make up the new amount. Okay, at the end of the day, the 50 million is taken directly to the parent because it's the solely of the parent. And that of the subsidiary, 25 million, is taken 80% of this 25 million comes to the parent as 20 million, and 20% of the 25 million comes to the NCI as that. Now, the question then is this, I'll put it to you. The finance costs is actually the cost or expense of who? Is it of the parent or of the subsidiary? And who will be affected ultimately in that case? Who will try to answer? Anyone?
I think it should be for the parents, sir. I think it should be for the
Why?
parents. Since the parent is the one, what's it called, acquiring the subsidiary.
Yeah, it's the parent that is owing, and it's owing as a result of his acquisition of the subsidiary. Therefore, this is solely of the parent. Therefore, I'll link this 4 million as solely of the parents. This 4 million is solely of the parents. Okay, and that's how we're able to attribute this profit. Invariably, what do we have? We have this position of the group: revenue, cost of sales, gross profits, distribution cost, admin expenses, profit before interest and tax, finance cost, profit before tax, income tax, and profit for the year. Now, you find something that in reality, be wary of jumping, except if you are using Excel, to just assume that exact information here is what you create in this schedule. No. The more you are familiar with solving problems, having read all the information here, you will know whether there will be 1 or 2 additional lines that probably has not been reflected here that you need to reflect here. Example is finance costs, finance income. But many of other adjustments will either be adjusted within revenue, adjusted within cost of sales, adjusted within distribution costs, adjusted within administrative expenses, or adjusted within tax. But for those ones that are of special item that need to be shown separately, such as finance cost, investment income, or other finance income, all of those ones may require you to create additional lines that were not existing before. Okay, and that is that. But the beauty of Excel, the beauty of Excel is that you can always insert above, insert beside, insert below, and all sorts of things. Therefore, that's not a problem. But if you are doing anything paper-based, it can become a problem, which you now have to cancel and try to reorder. Okay, you can ask your question.
All right, thank you, sir. The question is actually related to what you said now, because I was trying to check the financial statements and annual reports recently, but I observed from the reports that despite the fact that they are presenting their statement of profit or loss by function, like they are classifying their items by function, I still see impairment, like they still, what's it called? They still prepare a separate line. Yes, even inclusive of that of what's it called? That financial what's it called? The statement of profit or loss that is presented by nature. as well as function, they still separate that impairment
Yes.
loss or impairment.
I'll tell you why. The reason being that IS1 provides you that though you have these defined line items, which we call class or line items, but the standard also permits you that where you have material transaction or significant transaction, which is of importance, that showing it separately will more or less enhance the understandability of the financial statement by the stakeholders or the users. Therefore, you are not limited to showing such items separately. For example, if in a year I have what I can call unusual item, I have exceptional or whatever you call it, you can report it separately in that year so that people can see that this is a one-off item that may not recall, or this is of a material nature that requires separate presentation in the financial statement. Do you get it now, sir?
Yes, sir, very clear. Thank you.
Any other question? Okay, if there's none, I think I've addressed that. Okay, now the next thing is our retained earnings, our statement of changes in equity. We need our consolidated retained earnings, we need our NCI. Okay, what then do? We come here. What is our information? We have pre-acquisition reserve. Okay, we acquire when on 1st of January 2016. What was the reserve on 1st of January 2016? Do we have the information? Yes. 1st of January 2016. This is retained earnings of the subsidiary brought forward. Can you see it?
Yes.
Which means, in this case, if you are not diligent to know that this income statement will have begun 1st of January, therefore you will have presumed, or you might not have gotten it rightly, that this 20 million is our pre-acquisition. This date and this period brought forward at the same date. Therefore, this is our pre-acquisition, which I'll come here and say 20 million. Remember, all figures are in thousands. Let me copy that. Okay, now what is our subsidiary retained earnings brought forward is the same amount, which means when you now find the difference, like we always do, well, we'll find the difference. Let me pick this. Let's pick this expression. Yeah. Well, find the difference. You find that the difference is 0. Why? Because we acquire on the same date, which means all of the reserve were post in that case. Okay. All of the reserve were pre in that case. Sorry. Now the parent retained earnings brought forward is 120. And non-controlling interest already is valued for us at 24. Okay, which means what then do we need to do is for us to find the consolidated retained earnings brought forward, which is the parent, 120. And as we are all aware, as we have said earlier, in any year of acquisition, your retained earnings brought forward is nil. Post-acquisition retained earnings brought forward for the subsidiary is nil, which is also what you have here. All because whatever you do here, which is 80%, and you apply it on the 0 amount, will still give you 0. Similarly, for the parents, you apply 20%, of that amount is still going to give you what? Is 0. Why? Because nothing is post. The entire reserve as at acquisition, which is also the opening balance, are the same. Now, NCI as at acquisition is 24, and that is that. Now, since this is the first year we acquire, this amount is reported as an addition upon acquisition of shares, which means there's nothing coming as opening because it's near. Okay, and that is the position there. Take note of it. In any year of acquisition, starting from the first day of that year, your value of NCI brought forward is nil. The only time you are bringing NCI for the first time was on that 1st of January, which is 24. And in that year, you attributed profit of 5 million, which is coming from here. Okay, and that is how we sum it up and we'll produce these results. Okay, and this is a full year. Therefore, there's no proration, even though this was acquired in this year, but it was acquired exactly on the first day of the year. Therefore, it's the exact 12 months. Supposing this is now February 1st, or that this year end year is September, therefore it will have been 9 months. Therefore, let us always take that into consideration. Any question on that? Which means the only new principal year, in addition to acquisition during the year or acquisition in a year, was issue of how do we unwind the discount inherent in the deferred cash consideration. Okay, now this is much easier because acquisition took effect this year. Let us now look at a situation where acquisition occurred probably a year ago. And that year ago, we have a deferred cash consideration. And that deferred cash consideration is payable in 2 years, but a year has passed, and probably we are in the second year. What will have been the situation in that case? Let us look at illustration 22 to deepen our understanding of that. Okay, illustration 22. Over to you guys. Can someone read?
All right, illustration 22.
Okay, Samuel, we can hear you. Okay, Mr. Anthony.
Okay.
Okay.
Arsenal acquired 80% interest in the equity of Chelsea as January 1st, 2015, when the retained earnings stood at 20 million naira. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Revenue, Arsenal, 6 million naira. Chelsea, 390 million naira. Cost of sales, Arsenal, 345 million naira. Chelsea, 201 million naira. Gross profit, 255 million naira. Arsenal. Chelsea, 189 million naira. Distribution costs, 75,000 naira. Arsenal. Chelsea, 75 million naira. Arsenal. Chelsea, 45 million naira. Administrative expenses, 105 million naira. Arsenal. Chelsea, 90 million naira. Income tax, gross profit on before tax, 7 million naira, 75 million naira. Chelsea. Arsenal, 75 million naira. Chelsea, 54 million naira. Income tax, Arsenal, 25 million naira. Chelsea, 29 million naira. Profit for the year, Arsenal, 50 million naira. Chelsea, 25 million naira. Movement in reserves, retained profit brought forward, 120 million naira. Arsenal. Chelsea, 65 million naira. Profit for the year, Arsenal, 50 million naira. Chelsea, 25 million naira. Retained profit carried forward, Arsenal, 170 million naira. And Chelsea, 90 million naira. Prepare the consolidated of profit and loss and the consolidated statement of changes in equity given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As an acquisition, the parent, in addition to the shares consideration, share exchange in brackets, offered to former shareholder of the subsidiary a cash payment of 2.8 million naira is due to be paid on 31st December 2016 to the shareholders who sold their shares, who sold their stakes to the parent. The hurdle rate in bracket or cost of capital of Arsenal is 20%. In this context,
thank you very much. Thank you very much. Yeah. Okay, we'll look at context together. Now, see what is, if one is not careful, the date has changed. Acquisition was no longer 1st of January 2016, it was 1st of January 2015, which was sometimes last year, January last year. Now, and they gave us the reserve as 20 million. Now, this year, between last year and this year, the reserve has increased to 65. Okay. Now, at the end of the day, what has happened? What has not happened is that this information remained the same, 28.8 million. And that was payable as at the 1st of December this year. And as at the time they acquired, it was 2 years apart. Now, let me copy and paste here. Let me switch to our Excel spreadsheet. These are spreadsheets. Samuel, you are raising up your hand.
Yes, sir.
Come back to you.
Okay.
I'll come back to you now. Now, here, similar to what we had before, the only difference here is that this is no longer correct. What is it now? This is now 1st of January 2015, and this is the same thing as 2016, which means 2 years has gone. I remember it was also 2 years payable, in this case 2016, and that 2 years has come now, which means that this same principle still apply. And what is the principle? Is for us to find the present value in period 0, which means we discount it back. Okay. Now we'll look at what is the implication of it, whereby the finance cost for year 1 will have been reported in 2015, between January and December. And now, finance cost of year 2 will be reported in 2016, between January and December. But if you cross the line, everything beyond this period would have affected the opening consolidated retained earnings, which is your consolidated retained earnings brought forward. Okay, the same thing as brought forward. Now, which means we'll make this to have effect on this, our consolidated retained earnings brought forward. This portion here. Okay. Now, this portion here, though will affect retained earnings, but it will affect retained earnings through our profit or loss. Let me draw the line. Through our profit or loss. Moving like a snake. And this is the terminal point. finance costs. It's not easy to use expense. Okay. Okay. And that invariably will reduce our profits for the year, which will close out here. Yeah. Therefore, what then do we do? Is to replicate what we have done before, but move one step further in that. But before then, let me attend to Samuel. Samuel, what's your question?
All right, sir. I just want to be clarified as regards this nomenclature that was used there. I knew you've explained it before, but seeing it here, I'm not really too clear about it. As regards the acquisition of Chelsea. Now, on the requirements, there's an aspect that says that as an acquisition, the parent, in addition to the shares consideration, shares exchange offered to former shareholders of the subsidiary, a cash payment of. So I just want that aspect. I knew we have cash consideration and we have a share exchange.
Now, so far it is share exchange. I think I noticed then. This is not the first consideration that was delivered was not cash, but share consideration. This is not cash, but share consideration.
Okay.
Yeah.
But
okay.
What they said they paid, I think they now said they paid cash. And
they have to pay additional cash.
Okay.
No worry, I'll come back to it and I want you to read it. Probably you didn't read it along with the person that read it.
Okay, sir.
Okay, now read it here. Let me show you. Yeah, read it here. Read this sentence here. As
okay.
Yeah, read this here.
Okay.
As acquisition.
Okay. Arsenal acquired. Yes, sir. I'm there.
No, you are not reading what I said. Read from here. As acquisition. The parent, that's the last paragraph or the last sentence.
Okay, I'm coming. Is my screen. Okay, as an acquisition. Okay, I'm there. So as an acquisition. Yes. As an acquisition, the parent, in addition to the shares consideration.
In what? In addition. In addition, okay, continue.
To the shares consideration, that is share exchange, offered to former shareholders of the subsidiary, a cash payment of 28.8 million naira is due to be paid on 31st December 2016 to the shareholders.
What does that mean? When we discussed issue of consideration, we said, apart from consideration you have made today, you might still have commitment to make further consideration, which is deferred into the future. Now the future has come.
Okay. It's all right, sir. I get it.
Now the future has come. Now let us measure it now. The future value was 28.8 million. The discount rate was 20%. When we discounted, we had 20 million. Now, in the first year, which is 2015, we've recognized 20% of this 20 million, which is 4 million. Okay, let me go back to here where we have that. If you remember this, I can copy it for your sake and bring it down here. There's no space there. I can put it here. Okay, which is year one. Now, our year one in this case is 2015, this 4 million. Now, But this 4 million, you'll find out that I said something that though it goes to profit or loss, but this profit or loss will have been 2015, which invariably will reduce the consolidated retained earnings as at that 2015, which automatically impact our retained earnings in 2016. Now, in the second year, which means as at end of year one, the balance as deferred cash consideration will be the 20 million plus the 4 million. Remember, 20 million is the present value amount, and you have on one 4 million, which means as at that date, you now have 24 million. Now, if we are to unwind discounts, unwinding of discounts in year two, you must know what your balance is in year one, which means your finance costs or unwound discounts in year two will now be your cost of capital times PV in year one. And remember, this is PV in year one. It then means that will now be 20% of 24 million. And what is 20% of 24 million? It's 4.8 million. And that is that. Let me write this one well. %20 of 20 million, and that's. And this is what I try to do here, which means in year one, after doing this, our balance in year one will now be 24 million. Now in year two, we'll now calculate 20% on that 24 million. Okay. And that will give us 4.8 million. Let me write this in millions so that it doesn't confuse you. Remember, we have been doing all figure in what? In thousands. And that is that. Take note of it. All figure in thousands. Or figure in thousands. Okay, does that make sense now? Which means by the time you do it for the year two, you see that the balance here, as at end of year two, the balance of the deferred cash consideration will be 24 million, which was last year, plus 4.8 million. So you've now reached your future when settlement is due of 28.8 million. Remember, when it's future, when settlement was due, the cash payment is due on what? On 31st of December 2016. And this is how we are able to prove that we move from 20 to 28.8 million. And that's what you can see here. The process here. And that is that. Take note of it. Now, that means that in the current year, 4.8 million is what goes into our finance cost. This 4.8 million, which is what you found here. Whereas last year, it was 4 million, which you are going to see within the retained earnings brought forward. Well, let's go back here. Let's copy all what we have from the question, and we'll produce this. Okay, remember, 50 million goes to the parent solely because it's from the parent's books. 25 million is shared as ratio 80-20, which is now 20 million and 5 million. Now, the entire finance cost is a burden to the parent, which I have here, 4.8. Remember my 4.8. Okay. And that's how we're able to attribute profits. Now, what is our retained earnings brought forward? In this case, is 20. Sorry, pre-acquisition retained earnings, in this case, is 20. Now, this has been acquired before now, and our retained earnings brought forward was 65. Parent retained earnings brought forward was 120. And non-controlling interest at acquisition was 24. Okay, what then do I do? My tenant brought forward is 120, which I've done. My share of this is 36. Remember, what is my post-acquisition? I can copy this. And my post-acquisition brought forward is the difference between the subsidiary tenant brought forward and the pre-acquisition. And this 45. And how do I get this 36? It's 80% of this 45. And that's the 36. Remember, the entire on one discount of 4 million, I told you earlier, we affect the retained earnings as at 1st of December, which is brought forward as at 1st of January, which is what you can see here. Okay, and you can see it here. Remember the story I gave you here? The first half will affect retained earnings. The second half will affect the profits or loss for the year. This is the first half, the 4 million. And that's what you can see here. Okay. Now, and this is how we got 152 that's coming here. Now, the remaining one that is here is 65.2, which comes here, and the 5 comes here. Let me clean that so that you can be able to see what I've put up here. Okay, that is that. Now, if you come back here, you can see our revenue, our costs, which expressly are doing, finance costs, income tax expense, and the attribution. Okay, and this is how we got the effect of all what we've done. At the end of the day, we have this position the way it is. Any question on that? Any question on that? Okay, now I've been able to show you successfully if it's just for the current period and if it's for prior period, how you see unwind for only the current period, but of the cumulative effect, how it affects your opening consolidated retained earnings for the cumulative unwind discount in the prior years before the current period. Any other question? Okay, if there's another question, what we'll do is to move to the next level where we'll be looking at effects of preference shares and how do we treat preference dividend within the group in a situation where the preference shares is treated as equity. Okay. Okay, now, as we'll be speaking on the treatment of preference share, okay, I will make us further understand this in simple terms. And in addition to that, I'm going to make use of illustrations to denote our understanding of those basic principles. Now, the first thing here is that we are more or less in line with IAS 32, which borders on financial instrument presentation, we are going to consider these preference shares as equity instruments. As I said earlier, if we consider it as liability or financial liability, we will have treated it separately. In that case, the dividend will have been treated solely as interest expense, interest income, which is similar to what we have done under interest expense and interest income under loan. But in this case, we are treating it as equity instrument, which means it's an equity, and the preferred dividend will be treated similarly the way we've treated preferred dividend under the same way we treated preferred dividend under ordinary shares, which is ordinary dividend. Now, but let's look at the gimmick here, or the principle that underlies this. Now, every component of the preference share attributed to others other than the parent will be treated as non-controlling interest. Okay, while every component that relates to the parent will be treated as intercompany. And therefore, necessary elimination will have to be carried out. Now look at it here. The share of non-controlling interest where there are no preference shares within equity capital structure is very straightforward, which you all know before now, which is, in this case, where there's no preference share, NCI will just take its own percentage in the ordinary shares of the subsidiary and multiply it by the profits for the year. Now, this is on the premise that there's no adjustments for group items, which I've more or less considered before now. But there will be slight adjustment to these profits where there's a preference share and this preference share pays dividend. And those adjustments will be subject to the fact that whether the parent has a stake in the preference shares or not. Now let's look at one by one. Where the preference shares are entirely held by the parent, the non-controlling interest share will only be what is left of the profit after we have deducted the entire preference dividend that belongs to the parent. Which means before NCI partake in the dividend like the parent, all preference dividend will have been paid. But where the preference shares are held entirely by non-controlling interest, even though the preference shares will have been deducted before sharing the ordinary share stake to the NCI, the entire preference dividend will now be added onto the NCI because it belongs to other shareholders other than the parents. Because in this case, the entire preference shares are held by others, which are non-controlling interest. And lastly, what if the preference shares are partly owned, regardless of the percentage, between the parent and others are grouped as non-controlling interest in this case? Though NCI will still consider from the ordinary share perspective, take its percentage of what is left after deducting preference dividend, but will also add to it its own share of the preference dividend based on its own stake in the preference share capital. And that is how we do that. Now, how do we turn all of these metrics into reality? We are going to look at three scenarios. Scenario one is where the entire preference shares, in this case, I think is held by the parent. Okay, in this case, what do they say here? Okay, with the equity capital, the parent held all of the preference shares. I think that's the first one we're going to look at. Can somebody read illustration 23?
Illustration 23. Arsenal acquired 80% interest in the equity of Chelsea as January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of FIRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended 31st December 2016. Revenue, Arsenal 600 million, Chelsea 319 million. Cost of sales, 345 million for Arsenal, 201 million for Chelsea. Gross profit, 255 million for Arsenal, 189 million for Chelsea. Distribution cost, 75 million for Arsenal, 45 million for Chelsea. Administrative expenses, 107 million for Arsenal, 90 million for Chelsea. Dividend income, 2 million for Arsenal, none for Chelsea. Profit on before tax, 75 million for Arsenal, 54 million for Chelsea. Income tax, 25 million for Arsenal and 29 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Movement in results, retained profit brought forward, 120 million for Arsenal, 65 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Dividend paid, ordinary, 10 million for Arsenal, none for Chelsea. Preference, none for Arsenal, 2 million for Chelsea. Retained profit carried forward, 160 for Arsenal, 19 for Chelsea. Required, prepare the consolidated of profit and loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. Within the equity capital structure of the subsidiary, the parent had all of its preference shares as at the reporting time. In this context of this text, we will approach a step-by-step approach to explaining the movement of IFRS 10 with regards to consolidating the financial results of the parent and the subsidiary as depicted. Arsenal Group, consolidated statement for profit or loss for the year ended 31st December 2016. Revenue.
Okay. That's okay, sir. Okay. Thank you. It seems you like my contest. Okay. Thank you very much, sir. Anytime you see the contest, please leave that contest to me. Okay. Thank you. Now, in this question, there's preferential capital in the subsidiary, and the entire preferential capital is held by the parent. How do we now treat dividend paid by that subsidiary on preference shares? Now, the subsidiary, if you check the information here, the subsidiary paid 2 million as preference dividend. Okay, and we all know that it's only the parents that have all of the stake in it. Can we now say that 2 million is what translates to the 2 million dividend income here? Probably we'll say yes for now, because if you do the analysis, 100% of 2 million is 2 million. Okay, but you always have to do this analysis, otherwise, because you might have 2.5 here, which means there might be other dividend income other than that of the subsidiary's preference shares. Okay. Now, preference dividend paid or declared by the subsidiary was 2 million. We have 100% stake, which means NCI will have what percentage? 0%. Supposing we have 80% stake, NCI will be 20%, and that's what I've just tried to model there. Okay, having done that, what then do we need to do is for us to look at it that we eliminate intercompany dividend. In this case, preference dividend. Let me emphasize it here. Now, what then do we do? Is that 100% of the 2 million is what we are going to eliminate. Okay, which means I'll come here 100%. Which means if the parent is 80%, I'm only eliminating 1.6. If it's 10%, I'm only eliminating 200. And if it's 0%, I'm eliminating nothing. And that's what it means, which means any portion I'm not eliminating from the preference dividend attributable to preference share capital recognized as equity will be solely attributed to non-controlling interest. And these are the stories that are put there for you. Let me just put it in this color for you to take note of. Okay, now, how do we eliminate? I come back here and let's look at our question and let's copy all of the information. As we have it in our question. And that's what I've done here, copy all this information. But what portion are we eliminating? We are eliminating 2 million from our dividend income. And that 2 million is flowing from where? Our 2 million is flowing from here. Therefore, let's return back our percentage. Remember, nothing showing here, even though I've linked it. Why? Because remember, I put that the parent has 0%, but rather it's 100%. Therefore, we are eliminating this 2 million. This 2 million is what we have here. Otherwise, if it is 70%, we are eliminating 1.4, which is what we have here. Otherwise, if it's 0, again, we are eliminating nothing as it is here. Therefore, we take it back to our 100%. And that's what I've done here, which means I've eliminated in full. Now, if I have more than 2 million here, there will be balance here. For example, if I have 2.5 here, there will be balance of 500, which is a dividend attributable to other investments other than that of the subsidiary. Okay, but that's not the case here. Now, again, we'll come back. The entire profit here, 50 belongs to the parent, and this 25 belongs to the parent and NCI ratio 80-20. Now, who can tell me this dividend income we're eliminating? Who are we eliminating it against? Is it the parent or the subsidiary? And if it's the parent, who will be affected ultimately? And if it's a subsidiary, who will be affected ultimately? Who will answer me?
Since the parents had all of his preference shares as at the period, I think it is the parent that will be affected.
Now, it is the parent dividend income from the subsidiary that is being affected. Therefore, it's the parent that will solely be affected. All because the 2 million here is seated in this 50 million. Can you see this 2 million is seated here? Therefore, we are taking it out of it. And that means we have 68 and 5, which is the position we have here. Now, NCI is not having any effect of all of this, which means the formula we are using here, if we go back to our position here, is this. Which one is relevant here? What is relevant here is this. Which means in this case, we are deducting this preference dividend But NCI will not be affected by that because it's not entitled to dividend. And we're going to see that in determining NCI value. Now let's go back here. What is my pre-acquisition reserve? 20 million. As you can see it here. All figures in millions. $20 million. My retained earnings for 67 million. My personal earnings for 120 million. My non-controlling interest measured at acquisition did fair value 24 million. Okay, and this is it. Now you find out that this is our position as it is here. Now remember, the position is on the premise that the post-acquisition retained earnings brought forward is the difference between this 67 million, which is our subsidiary retained earnings brought forward, and the subsidiary's pre-acquisition retained earnings. That's 47. Now you find out that 80% of this is what we recognize after 7,600. And this 94 is as a result of 20% of this. And that is that. And that's how we're able to report 157,600 at 3,400. Okay, as usual, also, the entire amount here we've deducted that of the parent in that case. Therefore, what do we have in this case? We have this position. Okay. Remember, dividend paid by the parent itself will be used to reduce the retained earnings of the group, which is 10 million. Remember, this 10 million is coming from who? From the parents. Yeah. Okay. Now, that is that. Let us now look at the situation. If otherwise, it is the subsidiary, non-controlling interest that owes the entire of the preference shares. Hold on, let me switch. Okay. Let's look at this. Can somebody read this first? Who will read first? Illustration 24. Which who will read?
Okay, illustration 24. Arsenal acquired 80% interest in the equity of Chelsea as January 1st, 2014, when the retained earnings stood at 20 million naira. Income statement for the year ended December 31st, 2016 for Arsenal and Chelsea. Revenue for Arsenal and Chelsea 600,000 and 390,000 respectively. Cost of sales for Arsenal and Chelsea 345,000 and 201,000 naira respectively. Gross profit sums up to be 255,000 naira and 189,000 naira for Arsenal and Chelsea, respectively. Distribution cost 75,000 naira for Arsenal, 45,000 naira for Chelsea. Administrative expenses 105,000 naira for Arsenal, 90,000 naira for Chelsea. Profit before tax 75,000 naira for Arsenal, 54,000 naira for Chelsea. Income tax 25,000 naira for Arsenal, 29,000 naira for Chelsea. Profits for the year 50,000 naira for Arsenal, 25,000 naira for Chelsea. Movement in reserve, retained profits brought forward for Arsenal 120,000, for Chelsea 67,000 naira. Profit for the year 50,000 naira for Arsenal, 25,000 naira for Chelsea. Dividend paid or ordinary dividend paid is 12,000 naira. While preference dividend paid is 2,000 naira for Chelsea. Retained profits carried forward 158,000 naira for Arsenal and 90,000 naira for Chelsea. Required, prepare the consolidated statement of profit or loss and consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. Within the equity capital structure of the subsidiary, its preference shares are all held by parties other than the parent as at the reporting date. Thank you.
Thank you very much. Now, the reverse is the case here. All the shares, preference shares, are held by parties other than the parent. Since you treat preference share capital as equity in this case, the entire amount is reported as that of non-controlling interest. Therefore, let's fast track. Remember, we have 2,000 now. The parent has 0%. It means the entire belongs to other stakeholders, which is NCI in the preference shares. Okay, 100%, which means in this case, what are we eliminating? We are eliminating 0% of 2 million, which is 0. And that is it. Okay, which means if you come here, there's nothing to eliminate, even though we have dividend income. Therefore, what do? We'll come back here. You copy what you have here. There's nothing as dividend here. This is 0, this is 0. And that is that. This is what we have. And we produce our result in this manner. Now, there's nothing to eliminate, even though here we don't even have any income here, which also demonstrates that we don't have dividend income from subsidiary. Which means, what are we eliminating? We're eliminating 0, since the entire dividend is paid to others. We don't have one single share in the preference share capital structure. And that's that. Now, again, remember, preference share, pre-acquisition retained earnings brought forward from this information was 20 million. Remember, all figures are in thousands. All figures in thousands. My subsidiary retained earnings brought forward is 67,000. Parent retained brought forward is 120,000. Non-controlling interest at acquisition is 24,000 measured at acquisition date fair value. Okay, and we're able to produce this. Remember, the post-acquisition retained profit brought forward will be the difference between the 7 million, which is subsidiary retained earnings brought forward, and the post-acquisition retained earnings, which is 47. It's from that 47, if you remember, we have the 80% here. I just continue to repeat this so that we get used to it. Remember this 24, not 240, 24. And this is the 20% of this 47. That's that. Now, how then do we adjust? The entire 2 million belongs to NCI, which is what we adjust as a deduction because a payment will reduce the share of profit in this case. Therefore, in this case, the profit of the subsidiary was entirely how much? The profit of the subsidiary was 25, okay, of which we deduct 2 million from it, okay. If you deduct 2 million from this 25, it remains 23. It then means that 23 is what we share between the parent and this, okay, and probably come back for NCI to add back the preferred dividend. Therefore, in this case, what I'll do is I'll take 80% of this 25 minus the 2 million. Remember this 2 million. And it means what is distributable between the parent and NCI on the basis of ordinary share is 23 million. That 23 million, parent take 80%. The same 23 million, NCI takes its own 20%. Now, when you add all of it together, when you add all of these two together, what do you have? It should be 5, not 7. This 5. Now, when you add everything together, this is 23. Where is the 2? The 2 is what you add back to non-controlling what? Interest. And let's add it back non-controlling interest plus this 2 to make it 25, which means non-controlling interest to first of all take is 2 million because he owns 100% of that preference. What is left is a residual that is what is belonging to the other shareholder, in which NCI has 20% stake, parent has 80% stake. Now that is that here. Now, similarly, if we come here, I think we omitted it here. Now, here, the parents, let's go back, 80% of this 25 minus 2 million, the 2 million is the preferred dividend, which means it's still 18. NCI will take 20% of this 25 minus 2 million. Why? Because it's only 23 million that is available to the ordinary shareholders, having taken 2 million for preferred shareholders. Now, but the preferred shareholders are only of the parent, which means is the parent that is also entitled to that 2 million. It means you now come here to add the 2 million to the parent. Didn't do that before, which means that's how we share the 25. Which means where the parent owns 100% of it, the 2 million is coming back to the parents. Where the NCI owns 100% of it, the 2 million is coming back to NCI. And that is this formula that I tried to explain to you the other time. Let's go back to that formula. And I'm going to enlarge it this time around. Let me try and go back. Okay, this is the formula I'm talking about. Which means if the entire share is held by the parent, first, at every instance, you are going to deduct preference share from this to know what is due to ordinary shareholder. OCI take its percentage, which is what we've done, and the entire preference dividend belongs to the parent. Second one is if the entire preference dividend belongs to the subsidiary, you are still going to take this, deduct preference dividend from this, and what is left is for the ordinary shareholder, which NCI take his share, and NCI will come back to take all of his preference dividend, which is the second one we've done. Now we'll now see the third aspect, which we are going to reflect. Okay, take notes, and that's what I try to show you in this analysis we've done here. Now, all things being equal, we find out that now, since it was paid out, the 2 million will further be deducted from the 6.6, so that what is left is now 4.6, and added to 33.4 will give us 38. I remember, and the parent has his own 12 million preference share paid out already, which is a deduction from his retained earnings, and that is the position there. Now, the last one is where the parent owns a percentage of preference share capital, and likewise, NCI owns certain percentage or the remaining percentage, and preference dividend was paid by the subsidiary. Let us look at that from the illustration there. The final illustration, which is illustration 25. Can somebody read for us illustration 25?
I read. Arsenal acquired 80% interest in the equity of Chelsea on January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Revenue, Arsenal 600 million, Chelsea 390 million. Cost of sales, 345 million for Arsenal, 201 million for Chelsea. Gross profit, 255 million for Arsenal, 189 million for Chelsea. Distribution cost, 75 million for Arsenal, 45 million for Chelsea. Administrative expenses, 107 million for Arsenal, 90 million for Chelsea. Dividend income, 2 million for Arsenal, none for Chelsea. Profit on before tax, 75 million for Arsenal, 54 million for Chelsea. Income tax, 25 million for Arsenal, 29 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Movement in reserves, retained profit brought forward, 120 million for Arsenal, 67 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Dividend paid, ordinary, 10 million for Arsenal, none for Chelsea. Preference, none for Chelsea, 2 million for Arsenal. Retained profit in and carried forward, 160 million for Arsenal, 90 million for Chelsea.
Complete it with the requirement.
Sorry, I'm not getting the other side, please.
Complete it with the requirement. Is there?
All right, I'm just getting it. I'm just seeing it. Required, prepare the consolidated of profit and loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value at 25 million naira. Within the equity capital structure of the subsidiary, the parent holds 14% stake in the preference share capital, while the balance is held by parties other than the parent as at the reporting date. Sir, I'm done.
Okay, thank you. Thank you very much. Okay, now let's go back to our spreadsheets. Okay, same or similar information. Okay, 2 million. But in this case, we are told that the parent has 40% stake. If the parent has 40% stake, it means SCI has the difference between that 40% and 100%, which is 60%. Now, which means adjustment you are only going to make is 40%, which is 800. Okay, but let's go back here. What is the information we have with respect to the profit or loss of the parent and the subsidiary? What we have is as shown here, which is this. Even though the parent recorded 2 million, but what we are eliminating is 800, means the difference of 1.2 relates to dividend income from other trade investments. And that's what it means in this case. Other trade what? Investments. That's what it means. Other trade investments. Okay, which does not require elimination. You only eliminate to the tune of that of the subsidiary or that of associate and joint venture, which we're going to see later today. Okay, that is that. Now again, profit to share is this 25 after deducting 2 million, which is to come here. 80% of 25 minus the 2 million. Remember the 2 million? Yeah. It means the parent get 18.4. Subsidiary get 20% of the 25 minus the same 2 million. The subsidiary gets 4.6. Remember, the sum of these two is now 23 because you have removed the 2 million. But don't forget, the parent owns 40% of 2 million. The SCI owns 60% of 2 million, being the preference dividend. Therefore, I'll add 40% of the parent back to it, plus 40%. I don't need to type it, it's already there as an input. 40% of this 2 million, I give it to the parent. And I give 60%, which is the remaining 60% of this 2 million, which is preference dividend to the subsidiary. And that's how we share it. And if we go back, that is what we have here in this formula, which means NCI will take its own percentage share, not the entire now, because in this case, he only owns 60%. You deduct the 2 million from this 25 million to get 23, in which NCI takes its share of 20%. Now, NCI now has larger share here, which is 60% of the 2 million. And that's how we determine our NCI. Okay, take note of it. Now, we'll do that, and we'll come back here. And that's how we're able to do that. Now, parent portion will be eliminated here, which is 800. While NCI portion will be eliminated here, which is 1.2. How do you get 1.2? Remember, the 60% of the 2 million. Because it was paid out of this profit. Therefore, you can't eat your cake and still have it. What is left here is now 4.6 after the dividend has been paid. Now, what we needed now is our retained earnings brought forward from the group perspective and the NCI brought forward from the group perspective. All other things remain the same as you all know it to be. Okay, subject to this elimination of 800. Now, what's our preacquisition retained earnings brought forward, which is 20 million? What's our subsidiaries retained earnings brought forward, which is 67 million? Parent retained earnings brought forward, 120 million. Non-controlling interest as at acquisition date, 24 million. Okay, now remember, as you all have it here, our post-acquisition brought forward is the difference between subsidiary earnings brought forward and the pre-acquisition, which is 67 minus 20, of which we take 80% of it goes to the parents, and 20% of it goes to the non-controlling interest. And that's how we have that, plus the retained earnings brought forward for the parents and NCI measure at acquisition date. We are able to produce, as you can see here, we are able to produce the consolidated retained earnings brought forward and the NCI brought forward. And that is that. And as you can see here, what treatment did we give? We gave a treatment that reflects the elimination of intercompany dividend. If you remember, we said preference dividend, which is treated in similar like with ordinary dividend, and that is that. Any other question? Which means if we come back here to say this is 100%, we'll get the results we got first in the first example, illustration 23. Okay, if I say 100%, you see that we eliminate the entire 2 million, and you can see the effect here. This is for 2400, which is simply as this question 23, 2400. Now, if we say it is 0% and everything is NCI, you see that it is 18466, nothing to eliminate. And in similar vein, you get what we got here, where there's nothing to eliminate. Yeah, as you have it here, you can see it here, and get the same result, which means this third and final situation has modeled all the possible scenarios such that whatever I tweak to, we are going to get the same result at every point in time. Any other question? Any other question? In the absence of no question, any other question once again? Okay. Okay, is there any other question so far as we close on this chapter? Any other questions so far as we close on this chapter? Okay, if there's no question, that brings us to the end of a consolidated statement of profit or loss and other comprehensive income. The next section will be on investments in associates and joint venture. How do we account for those investments in group accounts or in the books of the investors?